This is Declarations.
To me, it's all about family. I consider my company my family. It's just an extended part of my family. I treat everybody like that.
Hi, this is Todd Rich, and thank you for listening to the Declarations podcast. The purpose of this podcast is to engage with thought leaders in investing who provide an independent perspective. Our goals are to explore the foundations behind their success, to understand the source of their inspiration, and through these conversations, to become better investors. We hope you enjoyed today's episode. Today, we're super excited to welcome Jack Dwyer to the podcast. Jack founded Capital Funding Group in 1993 and established a leading mortgage banking business focused on lending to owners of nursing homes and assisted living facilities. Involved in over $7 billion of FHA-insured healthcare mortgages, Jack has created a family of 11 companies offering a full service of financing solutions for the healthcare sector and the Mid-Atlantic business community. In 2009, he expanded into commercial banking by acquiring the troubled Americas Bank, which was ultimately rebranded as CFG Bank. A consummate entrepreneur, Jack was perhaps an unlikely banker at first. But under his leadership, the bank's assets have grown to $5.5 billion, and CFG has been recognized as one of the top-performing community banks throughout the United States. Often wearing his Ravens purple or Orioles orange, Jack is an active leader in the Baltimore business community, recently moving his bank headquarters downtown, sponsoring the CFG Bank Concert Arena, and serving on the board of the National Aquarium. Together with his wife, Nancy, Jack has taken an innovative approach to philanthropy with a focus on workforce development. I'm hopeful you will enjoy today's conversation. Jack, welcome to today's podcast.
Thanks for having me, Todd. I appreciate it.
Well, Jack, as you know, I like to start all of these podcast conversations in the same way. What is your declaration?
First of all, I love your name, and I love, the fact that it's based on the Declaration of Independence, and I can't really say anything as fancy as that. That is a great idea. But I came up with, so look, my whole career has been in the healthcare industry, and it has grown since then. But my concept always was to become like one-stop shop for my clients. So when I came up with the name of Capital Funding Group, I said, look, basically now, predominantly I do debt lending, but I really didn't want to just limit myself to that. I wanted to become one-stop shop for everybody. So I thought, it has to be something more than that. It's got to be something related to capital, because ultimately I want to be their whole provider of capital. So somehow I came up with Capital Funding Group, and that's stuck.
So your concept was provide all of the capital that some might want and to fund it, right? That was it.
Yes, that's exactly right. Yeah, so
great.
Simple, straightforward, basic, but got the job done.
We'll do a deeper exploration of that. But first, I'd like to explore a little bit of how you got into this business. And so maybe we'll start from the beginning. You grew up in New Jersey, probably, I don't know, no more than 10 or 15 minutes from where I grew up. And I think, if I remember correctly, you shared a bedroom with your two brothers. So tell me, what was your family like? And how did that, that experience growing up in New Jersey, how did that shape you?
First of all, I love New Jersey. Great
As do
state.
I.
Yeah, so very partial to it. And it was actually fantastic. My two brothers. So I have an older brother, Jim, and my younger brother, Glenn. He's been 6 years younger than me. And in general, it was typical brothers that, a lot of love, but a lot of fighting.
Sounds like business.
Especially with my older brother. But one thing was for sure, that Dwyers always protected themselves. So if there was ever an issue associated with a brother, then all the other brothers would basically go in and take care of the situation. We were very competitive. We all played sports. Every one of us was either the captain or the co-captain of the football team in high school. Very motivated, took leadership roles at a young age. It was sort of instilled in us by our dad and mom and our football coach. So there was a football coach in, Mattawan Regional High School, a guy named Barry Rizzo. Amazingly enough, he used to run this single wing. I don't even know you remember that, but it was
not the type of offense that we're running.
A crazy formation that he used to run that no one else did. But he really instilled in us a lot of leadership skills. So I remember the coach chewing me out day one, saying, you don't seem to be taking the leadership role that your brother did. So you need to step it up real quickly. And so he chewed me out for probably 10 minutes in front of the whole football
And did that
team.
work?
Sure did.
Yeah.
From that point on, leadership meant a whole different thing for me.
I've never worked in your company, but I don't picture you having that same style. Is that the way that you build up your team as well? Is dress them down first and then build them?
No, never. I would never do that to somebody and I learned from that, and, since I was humiliated, but it did teach me to step to the plate. And in fact, I would never do that to anybody, but he did, and it worked. So, it kind of changed me in my leadership role.
You then, I guess, after learning on the football field, you then went to college for accounting. You came down to Maryland to sit the CPA exam, and apparently you never left. What drew you to Maryland, and why ultimately to Baltimore? Why did you stay? What did you find here?
I thought studying accounting in college was actually a fantastic thing in preparation for the business world, because you really understand the nuts and bolts of any company if you understand the accounting aspect of it.
By the way, my dad was an accountant. They sometimes joke that I was born with a green visor. So I totally understand the comment.
So to me, it was the right thing to do. And I determined it at a young age, really in high school, that there were plentiful jobs in the accounting profession. That was one profession where you were almost guaranteed to get a job outside of college. But I never really wanted to work in public accounting, because to me, I've always had entrepreneurial blood.
Right.
When I was a kid, I had a lawn mowing service. I was 10 or 11 years old, and I had probably about 10 different neighbors that I used to cut their grass once a week, and created a business when I was really young. And I always had this entrepreneurial spirit, and I really didn't want to work in public accounting. So I wanted that designation, though. So I wanted to pass the exam, and I wanted that designation. But you can't get that designation unless you work 2 years in public accounting.
Right.
And that's what helps you. That's what enables you to get that. But there were 3 states in the United States where you could pass your CPA exam and have that designation of a CPA. It was Maryland, Texas, and Iowa or something. So I took a job at Dun & Bradstreet for a year just to, work in New York City. My dad worked in New York City, and it was kind of good to do that. I got my feet wet at Dun & Bradstreet. But then I searched for a job in Maryland, and I found a bank holding company called Suburban Bank. And at the time, they were the 3rd largest bank holding company in Maryland. And I applied for a job there and took the job. I was really doing the accounting for all of the bank subsidiaries, but it enabled me to get to Maryland, move to Maryland, pass the CPA exam, have that designation. Of course, that designation does nothing for me today.
You moved here on a loophole, it sounds like.
Yes, totally.
And then just serendipitously ended up in banking. Is that correct?
Yes. I was working at Suburban Bank doing all the accounting for the subsidiaries, and that's what triggered my ultimate career, because one of their subsidiaries was a healthcare lending subsidiary that did FHA-insured mortgages under Section 232 of the National Housing Act, which is lending insurance for people who lend in the nursing home and the assisted living business. I'm looking at this business, and I'm like, oh my God, this business makes a lot of money. And then I start reading the statistics about the baby boom generation, the population growth. They said you could build a nursing home every day for the next 40 years and still not meet the demand that's going to be out there.
So
Of course,
you were
all that
riding the
some of
silver tsunami 30 years ago.
Yes, I read about it and I'm like, oh my God, this is the business that I'm going to get into. So then eventually I went to work for that subsidiary as the treasurer. I was still in the accounting side of it. And then I became good friends with the lead originator of that firm. And he kind of took me under his wings. And ultimately, I went into the origination side of the business until I saved up enough money to start my own firm.
Let's talk about that. That was in the early 90s. When you started CFG, it was not a good time in real estate. It was a real estate recession. People were having trouble with loans. What was the spark? What were you trying to achieve by founding your own company?
Well, the spark was definitely created by the fact that I was negotiating with the person that owned the business at the time. It was a subsidiary of Suburban Bank,
Okay.
and Suburban Bank had part of it. And the guy who created that particular subsidiary, he owned a chunk of it also. So I was really negotiating with him to have a piece of the ownership. I was the majority of the production. So he kept negotiating, and I'm like, you know what? That's it. I've saved up enough money. I'm just going to start my own company.
It's incredible, though, the amount of ambition that I have found has been sparked in general by you and other of my podcast guests, where they felt like they wanted to own something, were willing to be partners with the people that originally, helped them. For some reason, that negotiation didn't come to fruition, and it created this entrepreneurial drive to then go it independently.
Totally. It's taught me that I have people that work on my company today that I'm partners with.
Right.
They have promote like minority interests, and that's what they asked for, and that's what I gave them. I learned that was appropriate to do that. And why let go of somebody good? And there's enough to go around for everybody, in my opinion.
Good for you. So let's focus now. The business model, and you started to highlight this, was focused on healthcare real estate. And so for people who aren't as familiar as you are, those are things like nursing homes, assisted living facilities, maybe medical offices, perhaps. I'm not sure. What is different or unique about these properties, and how does that, ultimately translate into a different type of lending strategy or capital formation?
Well, and mostly it is nursing homes and assisted living facilities. And I think a long time ago, I realized that there's really no capital for that group, for especially nursing homes. Assisted living, there's a little more access to capital, but very little debt is available for them.
Why is that?
Mostly they're worried about their single purpose buildings. I mean, there could be an alternative use, but it will take a lot of money to convert the building to something else. So typically there is no alternative use. And so most lenders shy away from things that can't be turned into something else. And then the other thing is you're talking about elderly that are in the building, and there's some reputational risk. If a lender forecloses on a property, it's headline risk. People don't like that. As far as I'm concerned, I'm okay with that. And again, I've always tried to build the one-stop shop. So I operate facilities myself. I have operating businesses, and I own nursing homes and assisted living facilities. So maybe it's a little easier for me.
You didn't start that way, right? You presumably started originating loans, and it's just that as you've grown more familiar with the business, I guess that was on the origination or servicing side, perhaps. Then you became a lender that took balance sheet risk on the debt side. It sounds like then you became an equity investor, and then now you also have an operating ability and certain operating entities. Is that correct?
Yeah, that's correct. When I do HUD-insured mortgages, that's ultimately the goal, which is long-term fixed rate, non-recourse. Great mechanism of financing. It's very difficult
Just to explain to people who don't understand, a HUD-insured mortgage. So this is HUD is a government agency, Housing and Urban Development. And how do they insure mortgages? Just a quick primer for people who may not know.
So Section 230, there's various different sections under the Housing Act. HUD does single family. Most people are familiar with that. HUD does multifamily, but they also have a program under Section 232 of the National Housing Act that they'll insure loans made to the nursing home, either for construction of nursing homes or assisted living, or refinancing nursing homes or assisted living. So it's a pretty obscure section of the act but HUD has a big business. They've done 50, 60 billion. They have on the books today.
And when you say that they insure these loans, presumably what that means is the HUD is not actually providing the debt capital. There are private lenders that are providing the debt capital, but there's some level of default insurance. Is that how it works?
Yes. So it takes a lot of experience and expertise and capital to get a license from a HUD perspective. But once you have that and prove to them you can do that, consider you a HUD-insured mortgagee, and you have the ability to make loans, and you have to convince HUD to insure your loan. So there's a whole application process that you have to go through and convince them that the loan is worthy of being insured by HUD. Once you get that mortgage insurance, then you can ultimately issue Ginnie Mae mortgage-backed securities, and that could be your funding mechanism for the loan.
Meaning there's a capital markets exit that can be provided because there are a bunch of investors who say, hey, I'm comfortable. Once HUD has gone through the process and they've insured it, I now feel comfortable. And so I'll buy the insured mortgage. I won't make it on my own because I'm not sure that my mortgage could get insured. Once someone else gets it insured, I'll buy it. Is that basically right?
That's 100% right. And so it makes it easier. Anybody will buy the Ginnie Mae mortgage-backed securities. Not anybody, but almost anybody,
right,
because you have the full faith of the United States government behind it. So if the loan defaults, I could just assign it back to HUD, and they'll pay 100 cents on the dollar for the claim.
Got it. Presumably you can't do that very often, or else it would be hard for you to then get the next loan approved.
That's correct. If you do that too many times, they could potentially kick you out of the program, although they don't usually do that. They just scrutinize every deal that you put in, and rightfully so.
And it is worth knowing, and this is publicly available, but I will say that your bank has a particularly strong track record with very, very, very low losses.
That's correct. I've never actually assigned a loan back to HUD, and that's what they love about me. And that's all part of, I own and operate buildings. So any lender who lends money is always going to have some type of problem with a loan somewhere along the line. And if they don't, then they're not lending enough money.
Right.
So, the bottom line is, if you have a problem, my theory is, rather than just assign it back to HUD, I'm going to roll up my sleeves and fix the problem. And I use my own capital to fix the problem. And so HUD loves that. And they like, Jack, you're the only company that actually does that, because usually what happens if there's an issue with a deal and it goes on for a month or 2 or 3 or 4 months, the lender, they're allowed to do this. They just assign the loan back to HUD. And then HUD doesn't really have the expertise to really handle that loan. They don't have the skill set to really work out that deal. And they wind up putting it in a note sale. And they wind up getting 20, 30 cents on the dollar. And at that point in time, the facility's probably lost its license and the building becomes almost worthless. Yeah.
Right.
Yeah.
And presumably you have a division that actually can buy that stuff and turn it around.
That's exactly right.
Right.
We do that. We do that all day long.
And so let's talk then what it means to be then a one-stop shop, a true capital funding group. Let's talk through what your vision was when it started, what your vision is today, how it has evolved.
So I'll talk about the nursing home industry. The nursing home industry is pretty much somewhere between 70 to 80% of the patients that go into nursing homes have Medicare or Medicaid. And so they're all government contracts, and ultimately they pay for the services that are rendered at the facility. They just don't pay in a timely manner.
Full faith and credit of the government. It's just slow.
It's just slow. So we've created the accounts receivable company, Capital Finance, which is a subsidiary of the bank. And for all of our clients, we'll provide them with a working capital line of credit. And we basically lockbox their receivables, which is no big deal for them. Everything just flows through our bank.
So this way, even if the government pays the payments late, they can still make the interest payments on time.
Yeah, that's correct. So,
Okay.
it's perfect for me because I usually do it when I have the real estate loan. So I make sure that they have adequate working capital so they can continue to, I just pay myself is basically what
Right.
happens. That's what comes out first. And then, actually the salaries come out first. Patients are always first.
Sure.
And then, we make sure that we get paid. And that was the first endeavor. Well, I shouldn't say that's the first. The first was bridge lending because, the HUD is so slow that if somebody's doing an acquisition of 10 nursing homes, no seller is going to wait for them to get a HUD-insured loan because that could take 9 months.
Right.
It's just, no one's patient enough to wait that long. So I created the bridge lending program, and that was the first step in the one-stop shop scenario. And the other, I have a company called Capital Senior Ventures, and that company, so there's a lot of people that do a great job from an operations standpoint in the nursing home and the assisted living industry, but they're capital constrained.
Right.
And so there's a whole healthcare group of real estate investment trusts out there, but ultimately those type of people could go to them, but then they'll never be able to buy that building because the REITs, will keep it forever. So I came up with this concept where I'll buy the building for them, give them 100% financing, and they have the right to buy it anytime within the third to the fifth year. So typically what
That's
happens is they find this building that needs some work and needs some assistance. Maybe it's a small operator that hasn't kept up with the times and is losing money. So one of my guys who really does operations well, he says, "Look, Jack, I want to buy this building. Would you buy it for me?" So I buy it through that entity, and then they turn it around and then they buy it back from me anytime from the third to the fifth year. And the result is I've basically 100% financed it for them. And then they've created so much value 3 years later. Then I can 100% finance it for them again because they have a purchase option for whatever to buy it for $10 million and it's worth
Right.
$20 million. So I can get them 100% financing on the back end too.
Now, most lenders don't typically talk about providing 100% financing.
No.
They typically want an equity cushion. Why have you decided to do that? That's typically what I think of as an equity investor as opposed to a lending investor.
Right. And yes, and I do that outside of the bank. Those are some of the companies that are outside of the bank. And yes, I get equity returns on that. And I usually do it in conjunction with debt and equity. But I'm basically, in essence, leasing them the building. And I have a built-in equity return for my equity when they execute in 3 to 5 years. That's what happens.
Full stack capital solution. Now, you mentioned outside of the bank. So just to make sure that everybody understands what you mean, I guess, following the financial crisis of 2008, 2009, there was a local Baltimore bank called America's Bancorp, and it was in trouble. And I guess you saw an opportunity to buy that bank in a moment of distress. It's now CFG Bank. And so CFG Bank is the entity that when you say is the bank, some of the other activities are outside of the bank, presumably because of the regulations and what it means to own a bank. So let's just talk, you as an individual, really in this lending and a little bit of, equity side, you now want to go and buy a bank after the financial crisis. Were the regulators really welcoming? Did they open up their arms and say, "Thank you, Jack, for showing up"? How did they treat you?
Not really. So I may have never even purchased the bank, but what happened was the way I used to do bridge loans prior to purchasing the bank, I had probably $500 million worth of lines of credit from Bank of America, Credit Suisse, all the big banks.
Mm-hmm.
And someone would come to me and say, "I want to do $100 million purchase of nursing homes." I would finance it through my lines of credit, mark up the money, and ultimately take them to get a HUD-insured mortgage and then pay down the lines. So when the financial crisis happened, all of those banks pulled my lines of credit, said, "We're done." That was the first thing that basically got pulled, lending to other lenders. So I'm like, you know what? I'm never going to put myself in this position again. I'm going to buy a bank. And so
Oh,
a lot of my banker friends told me that I was insane, that don't buy a bank, that when you have this level of regulation that you're going to get, there could be a problem. And I'm like, wait a second. I do deals with FHA. I deal with that agency. I deal with Ginnie Mae. They said, no, the banking is a whole different level of regulation. I just ignored them, bought the bank. So the bank was like $100 million bank that.
you're saying the American Bancorp was $100 million.
Yeah, it was a very
Fine.
small bank
Very
with
small.
3 branches. And I like to joke about their motto. So their motto was, if you have a pulse, we'll give you a mortgage. So they had so many bad mortgage loans. It was probably months away from being shut down. So I approached the regulators and say, look, I want to buy this bank. And I couldn't wait. I didn't have a banking license, so I couldn't wait for the regulators to take it over and then try to buy it at 20 cents on the dollar. You can't do that unless you're a approved banker that has a license already. So I couldn't do it that way. I had to just go in and buy it, and then subject to their approval, and they had to give me a license to buy it. So
Now, presumably, though, I guess it sounds like you paid a premium relative to what you think it would have traded for after they took it over. You couldn't have paid or wouldn't have chosen to pay very much if you think they're at risk of being taken over, though.
well, yeah, I wound up paying $100 or something. But the problem was, since I bought the bank, I had to subsidize all those losses. So I probably paid,
Right.
20, 25, $30 million in losses that my other companies had to subsidize over the next 2 years.
Got it. You think that was a good deal, or you thought that was a good deal at the time because it provided a source of permanent financing to keep the lending machine going?
That's correct. That's exactly what it did. And it would have been better if I could have just unloaded those loans to let the FDIC take it over, let them have the responsibility of the loans, and I just take the license and the charter.
Right.
But I couldn't do that.
So they should have been thrilled then. They said, great, I could have as a regulator or the FDIC had all these losses. Instead, I found this guy in Baltimore who's willing to pay me $100 and then take the losses himself. They should have been thrilled.
And you would think that would be the case, but the regulators, they don't really think that way.
Okay.
And
How do they think?
The way they thought was, wait a second, this guy's really not a banker. He's been basically a specialty finance guy that does nursing homes and assisted living, focused on one particular group, and they didn't really want to license me. It was a struggle. I'm like, guys, I'm putting in all this capital. I'm saving 40 jobs. I'm saving you from eating $30 million or $40 million. It's the right thing to do. And eventually I convinced them to do it. But for years, they put me on watch. It was a troubled bank. So I inherited a bank that had a consent order. They didn't lift that consent order. It took 7 years before they would lift it. I had to basically prove myself to them. I've grown it from 100 million to this year will be about 6 billion by probably the end of this year.
Wow. So subsidizing those losses, it turns out may have been a pretty good idea then.
Yeah, it was a very good idea.
Now, when you decided to buy the bank, or maybe even going backwards when you founded CFG, what were some of the founding principles? What was it that you think really led to your success personally or as a banker?
I know exactly what that is. This comes from my family upbringing. Maybe I touched on this a little bit, but to me, it's all about family. I consider my company my family. It's just an extended part of my family. I treat everybody like that. You could go to anybody in this company and go walk up to them and ask that. And that's what I do. So certain things that I do, like health insurance, I pay for 100% of health insurance for people. I pay for and provide childcare. I subsidize dog care. I want people coming into the office, considering this a family, And that's the way I conduct business. That's the way I run the business.
Now, when they retire, do you then find them a place to live in one of your nursing homes?
Yeah, but I could do that. That's another thing I could add to the list. But everybody loves that, and everybody knows that I'm going to take care of them. I pay them well. We have very little turnover, and I share profits. I mean, I think that kind of separates me from a lot of people.
Hi, this is Todd Rich. Thank you for listening to the Declarations podcast, where top investors and business leaders share their insights and provide an independent perspective. We hope you're enjoying this episode. If you'd like to learn more about Declaration Partners or listen to more episodes of the Declarations podcast, please visit our website at www.declarationpartners.com. And now back to the episode. Well, obviously, you've been in the healthcare sector for many, many years, and you talked a little bit about how CFG's model more broadly is a little bit different from a typical model, and you've clearly grown. But since the GFC, right, the healthcare industry has not been fully immune from setbacks. And actually, during COVID, it's probably true that the healthcare sector had maybe some of the biggest setbacks, perhaps more than any other sector. There were obviously terrible health effects temporarily. There were staffing shortages. There were cost pressures, a lack of demand. I mean, it sounds like a terrible operating environment. So during that period, how did you and your clients either hold up, or how did you respond to that set? Maybe there's a set of opportunities that came out of that. How did you respond?
Well, so as soon as it happened, one of the first instances of COVID, if you remember, there was a nursing home in the state of Washington that had an issue, and I had the loan on that deal.
Oh,
yeah, and it's a company called Life Care Centers of America. They're probably at either first, second, or third largest in the country, and
okay.
I financed over $1 billion worth of nursing homes for them. But they had pretty much the first case, and I don't know if you remember, but a couple of people died, and then they tried to attack them. They were providing bad care, and that's why these people died. And then, of course, the Department of Health went through a whole exercise investigating that, and they found out that it was all associated with COVID, so they were no liability to them. But when all that started to happen, and then COVID started to really break out, the Department of Housing and Urban Development called me up because I'm one of the biggest lenders in that space. So they were like, Jack, we have to do something. I mean, this is our whole portfolio. I mean, we really need to do something to help people. So I came up with a bunch of ideas where we could, so HUD makes you sock away replacement reserves for the replacement of equipment and roofs and, whatever.
Seems
structural
fair.
items. And so I'm like, guys, we need to temporarily allow them to use that to continue to pay their debt service, so we can keep them alive for the time being. So that happened out of the gate. But then the U.S. government did an absolutely fantastic job helping the nursing home industry and started subsidizing in a big way. So that really helped. Initially, we came up with the concept of the replacement reserves, but then the government stepped up huge. It was really a big thing. And that threw them a lifeline because they couldn't bring patients into the building. They banned admissions.
Right.
People were dying in the facilities and occupancy was down. Employees were dying.
Yeah.
It was terrible.
So the government came through not just to allow interest to be paid, but you're saying they provided subsidies to the operators. They allowed capital to be freed up for hiring additional staff. So the government really helped. And then I guess one of the things they did, we should acknowledge, is a different arm of the government perhaps, but then the Fed did start reducing interest rates dramatically through a variety of measures. That must have helped quite a bit also.
For sure. That was huge. It really helped.
And then one of the things that I noted that you did during that time is you decided to launch a new business, I guess, to acquire or separately finance in a different way certain of these loans that maybe other banks had on their books that they were nervous about. And so how did that work? You had more confidence than other banks in the ability to recover from an operating perspective?
Yes, for sure. There's a bunch of different things that I've done. During COVID, we basically started a fund outside of the bank. And so we had the bank capital and then we had the fund capital. And My partner didn't get scared away from COVID, and we were the biggest lender during that period of time. We probably did $6 billion worth of deals in the nursing homes and in the assisted living business, where people were fed up with COVID and the occupancy, and people were selling buildings. And I had a lot of clients that were buying the buildings, and I was doing all the financing for them. And in addition to that, we started to jump into the multifamily space in a big way with those same clients who had significant capital that were buying up a lot of the nursing homes and assisted living, mostly nursing homes. I started to finance a bunch of their multifamily deals. It was great. At the beginning, as you said, the feds had lowered rates, and rates were very low, and they became very attractive investments. And between the multifamily and the nursing homes and assisted living, we did $6 or $7 billion of deals during that period of time, and it was fantastic. I mean, I had competitors like KeyBank is a very big competitor. Not many banks do nursing homes and assisted living, especially nursing homes, but KeyBank happens to do that. And I remember them calling me up, and actually I do use them myself when I do my deals because I can't finance my own deals. And so they were like, guys, you're like taking over the whole industry. I mean, we were on the sidelines doing nothing, not coming to work with COVID and and you guys are taking over the industry.
And you were doing that, it sounds like, outside of the bank. So your bank presumably was subject to the same regulatory strictures or pressures that they were under, but you just had a different arm to provide, again, a one-stop shop.
Yes, and the bank was doing a piece of it, but just a small piece. So they kept active in it. But yes, the bulk of it was being done outside in the fund. And we were securitizing it with A note and B note pieces. So it worked out great.
So then fast forward to today. So what has changed since then? I guess the operating dynamics around the senior housing space and the assisted living space maybe has gotten a little bit better than certainly it was right after COVID. But with regard to the multifamily properties, now interest rates have risen, 400 basis points or so. Walk us through the landscape today. What are you excited about, either as a bank or in some of your other arms? What are you looking to achieve?
So in the nursing home and the assisted living space, we're still quite comfortable. And yes, great rising rates hurt everybody, but there's much bigger margins in the nursing home and assisted living space that, they're able to absorb some of those rate increases, not so much in the multifamily industry. So, a 500 basis points increase in rates is kind of devastating to multifamily. It really is.
Well, so it's not just to the multifamily owners. Let's point it out. I mean, that in 2023, there were several bank failures, right? So there was SVB, First Republic, Signature Bank had, some of them, in particular Signature, had a large real estate exposure. I mean, it still feels as if there are regulatory or regulators and even investors seem quite concerned about banks that have large real estate loan exposure. What's your read of the sector?
So it's the exact same read. There is still some big issues associated with banks' portfolios, and we try to be innovative all the time. And so we came up with a program called Capital Relief Program.
What is that?
So same concept where we do an A note and a B note structure. So when you're a bank and you tranche up a deal to take a B piece, first loss position, and that comes off of the bank's books, goes to some other mechanism, say my fund outside of the bank. That A piece that the bank still holds, under Basel III, they get a risk weighting of 20%. A typical loan is 100% risk weighting, so you have to have that significant more share of capital allocated for that particular loan. And then if you tranched it up and kept the A piece, then you have 1/5 the capital requirement that you would have with a normal loan on your books. So it really frees up capital.
Just so I understand, you're saying if I'm a bank, I made a loan of $100, I now tranche it into an A note of, I don't know, $80 and a B note of 20. I sell the B note of 20. Obviously, I have less capital at risk. And I guess my A note, you're saying, is now somehow it's both safer and maybe viewed as safer. And so now instead of having to have 100% risk weighting on that 80, I have 1/5 of that.
Yes,
and
correct.
therefore I've now freed up a ton of capital actually to do something else, you're saying. And that probably, I'm not a banker, but that probably increases my return on equity on whatever I already own in that loan as well. Is that right?
Significantly, yeah.
So why wouldn't every bank who has too many real estate loans be trying to do that?
I think the only reason why they haven't jumped on that yet, a few have, but the reason being is the extend and pretend rule that periodically rears its head over the years to extend this loan again without writing something that will allow you to do this and kick the can down the road for a little bit. So if they're not under pressure from the regulators from a capital perspective, I mean, theoretically, what should happen is, okay, great, this deal's underwater now, so you need to take that same $100. You need to take a $30 hit.
Oh, just
capital.
Write it down.
Yeah, just write it down and right-size the loan. And
Right.
so I think a lot of regulators have not done that. I think they should have done that, but they did not do that.
So if I'm a bank that's worried that that might be coming, I'd much prefer your capital relief program, I guess.
Totally. I mean, they can bolster their capital, but, again, speaking banker to banker, and discussed it with a bunch of other banks, and they always seem like they're ready to pull the trigger, and then they never pull the trigger. And I think it's because the regulators don't put the gun to their head. And if they can just continue to, so you do find a lot of lenders that aren't making loans.
Right.
And the reason being is because they don't have the capital to do
capital constrained, and this
Yeah.
helps. That's so fascinating. Now, just this conversation to me reveals one of the things I've always thought about you, which is that you aren't really a typical banker. You're really an accidental banker that got in as an entrepreneur. And so maybe just to shift from the actual business to maybe the personal, what advice do you have for other budding entrepreneurs, for other people who maybe have learned something in their professional role? It could be someone who also got into public accounting, but it could be someone else who had some sort of an entrepreneurial bug and wants to do it differently. What is the advice that you would give to follow their dreams?
Well, I'll go back to something my dad told me years ago, and I used to watch him do this. He was a trial lawyer in Manhattan, but he was on the defense side. And so he used to always say to me, and he represented like Black & Decker, like somebody would, saw off their finger, and, he would represent Black & Decker. And he always told me, there's a couple of things I'm going to tell you. One is never become a lawyer.
Okay.
I would not do that. So I'm like, okay, well, whatever. Because I kind of I watch him, I'd go to court and watch him in action and da-da-da-da. And he says, if you're going to become a lawyer, become a plaintiff lawyer, because that's where the money is, and
Right.
he's on the defense side. He goes, but no matter what you do, I mean, and you see me on the weekends and all that, is work hard and prepare yourself well. That's really what you got to do. I mean, you really have to just put everything into it. Preparation is the key. And I would go in and watch my father present a case and his closing arguments and and watch him work over the weekend, etc. And, it was quite fascinating to me, but he always instilled the hard work. So it really takes hard work. And then this is one that I've come up with on my own, and listening is the key. You have to listen to people, to me, that's the key.
How do you do that? How do you make sure, especially, you're sitting on top of a bank and all these other entities, right? Some people may not tell you the truth, or they may say things that they think you might want to hear. How do you, in your position, ensure that you actually are able to listen?
I just try to be able to cipher through that and then continue to ask questions and try to get them to open up more. And, but a lot of time I've surrounded myself around a lot of people that that aren't afraid to say anything, and they will tell me the truth. You learn a lot from what people have to say. You really do. I mean, it's not good to blindly make decisions on your own. You really have to get feedback from other people, and it's extremely important. So, and I've always instilled that in my kids now. One of the best qualities you could have is to be a really good listener, because people really do have some interesting and good things to talk about, and you can learn a lot from that.
Just hearing you say this, so much of what you're talking about, right? Working hard, being humble, surrounding yourself with good people, listening to them. It's so clear that at your heart, you're a team player. And maybe you learned that from your brothers with football. But I'd like to talk a little bit about how you've taken maybe more broadly the word team to your community. At CFG, and I applaud this, you've created a real culture of giving back. I think it's fair to say that you've started with your home city of Baltimore. And just for the people who don't know this the way I do, you moved your company headquarters downtown to a new development of a new area in Baltimore. You frequently sponsor events at, Ravens games or Baltimore Orioles games. I know I've seen you there. You take pride in the arts. You sponsor concerts at what's now known as the CFG Bank Arena. You've been active in the National Aquarium, which is located in Baltimore for people who don't know. How do you think about the role of CFG, or really the role that more broadly any business can play to improve their home communities?
I think it's so important that, and again, Baltimore is my adopted home city. We grew up in New Jersey, but
we all like Springsteen, but I did see him in Baltimore.
Yeah. But I love Baltimore, and my whole career blossomed here. So it's always been instilled into me through my parents and all that, is to help people that, really don't have what you have. My mother used to do Meals on Wheels. My dad would help in providing pro bono type work. And it's just like they instilled into me, really have to give back to your community. And that's what I'm going to do. There was one you didn't even mention that. So I did the Mother Mary Lang School. So, after the Freddie Gray death, the west side of Baltimore was pretty much ignored. And I teamed up with the Archdiocese of Baltimore to build the first Catholic school called the Mother Mary Lang School. And that is thriving today. It's just done wonders for the west side. But same thing, CFG Bank Arena on the west side. Trying to do everything I can on the west side of Baltimore to get it, investment stimulated. It is. The University of Maryland's doing it now. It's like a big thing. It's really moving.
And that's those are just the corporate philanthropies. I think it's worth mentioning that, you and your family have been quite active philanthropically on the personal side too. And I guess in particular with your wife, you and your wife created the Jack and Nancy Dwyer Workforce Development Center and have focused on workforce development. So what is workforce development and what are you trying to achieve?
So I love all the things that I've done, but that's the one that's the most meaningful to me. So for years, I'm in the nursing home and the assisted living business. And for years, I hear people complaining about, oh my God, we have such a shortage of nurses and CNAs, certified nurse assistants. And everybody talks about it and complains about it. I've been listening to it for like 20 years, and it got worse after COVID. And I said to myself after COVID, I'm like, you know what? I'm tired of listening to all these people talking and not ever doing a damn thing about it. I'm just going to do it on my own.
An entrepreneur in philanthropy too.
Yes, I take $2 million, seed the Jack and Nancy Dwyer Workforce Development nonprofit company. My kids are involved. And so the goal of the company is to do two things: solve systemic poverty and create jobs in the nursing home and assisted living, any healthcare industry, in the total healthcare industry.
Those are big goals. Solve systemic poverty. But how are you trying to do that?
So basically, the model is set up to go into poorer neighborhoods. And we're going to do this all throughout the United States of America. But right now we're in Maryland, Texas, Florida, Kansas, Pennsylvania, and Delaware. But the goal is to go into poor neighborhoods and show them this great career path in the nursing home and assisted living space. And so most people don't even know that. So we go in, we tell them this great career path. We say, look, we'll pay for your training. And then a lot of times you go into poor neighborhoods, they have other issues like childcare, housing,
Right.
transportation. We'll pay for that. And then we'll place them at a job. So I have nursing home and assisted living people, clients all throughout the country. So we'll place them there. And if they stay with that company for more than a year, we'll pay for their college education to become an RN. And what we do is we follow them with caseworkers. So we're the liaison between the employer and the employee. And that's really helpful too, because a lot of times it's their first job.
And I imagine those are industries where you have a lot of turnover. And so this is a way to actually improve matriculation. It's not good just for these people, but probably for the companies as well.
Totally. And so these companies, because they can't find people to work, they use agency nurses, which costs 3 times the amount. And that'll kill a nursing home quicker than anything will, or assisted living, when you have to pay 3 times the amount.
Right.
And that's your highest expense. 60% of the cost is salaries. It'll crush you. But the question is, you might ask, well, okay, that's a lot of money. How are you going to do all that? And so this is the innovative part that works completely different than any other nonprofit. So I seeded it with $2 million. And then I told you I own a bunch of nursing homes and assisted living. So I owned, at the time, it was about 45 nursing homes. Now it's up to 69 nursing homes in Texas. So I owned it with a private equity company called Blue Mountain in New York. And they're no longer in existence. Well, I shouldn't say that. They're called Assured Healthcare. But anyway, great partner. But like any private equity, they typically, have a horizon of, somewhere between 5 to 7 years. And it was 7 years. And I said, look, I have a great idea. I want you to sell the nursing homes, and this way you can, cash out. You sell the nursing homes to the Jack and Nancy Dwyer Workforce Development Nonprofit. Okay, and then I told them what the mission was, and they had to leave some money on the table, which they did. And so basically now all those nursing homes are owned by Dwyer Workforce. I still manage them under my Regency portfolio, which is a management company. And assuming I do my management job properly, which I have done now for 10 years, if I continue to do my job properly, those buildings make somewhere between $50 to $70 million a year. And I get to spend that money on executing on that mission.
And how many people have you been able to employ so far?
We've only been open for a little over 3 years, and we've trained and placed 8,000 people.
8,000 people. That's
8,
incredible.
And our goal is to make it 100,000 people in the next 5 years.
Well, give a man a fish and he'll eat for a day. Teach a man to fish and he'll eat for a lifetime. Good for you. It's fascinating. You should be really proud, you and your wife, and all the people involved should be proud of that. Jack, it's time in this conversation when we go to our standard closing questions, sort of rapid fire, 3 questions. 1, what is a book that most influenced your thinking or personal development?
I'm going to give you this one because it's a recent book.
Okay.
So it's called Unreasonable Hospitality.
Fantastic book. I just read it.
Off the charts. I mean, Will Goodyear, I saw him like a year and a half ago. I went to a publicly traded REIT called NHI, had him as a speaker at one of their symposiums, and the guy is fantastic. And so,
for those who don't know, it's about the story of 11 Madison Park and how you can use unreasonable hospitality to give people really incredible hospitality-like experiences. And by the way, in The Bear, which is one of my favorite shows, it is referenced.
He helped write that, to some degree. But yes, that is one of my favorite shows too. But
great book.
Absolute great book,
The best advice that you have received from your parents or give to your own kids?
It's got to be the hard work element where, just basically, work hard, listen, that's it. For sure. That's it.
And then, Jack, right where we started with the U.S. Declaration of Independence, as you know, talks about freedom for life, liberty, and the pursuit of happiness. So, Jack, what do you do in pursuit of happiness?
Without a doubt, now, what makes me the happiest is what I do with Dwyer Workforce. I mean, giving back to the community, giving somebody a shot at life. There's so many people that, just really never had anything and have no access to anything. If you can make a difference in your life, their life, I mean, that to me, that's what creates happiness now. Look, I have a lot of different things and my businesses make me really happy, but real satisfaction comes from, helping other people.
Well, I love it. Let's end on that note. Jack, I think it's fair to say that you have influenced many, many people's lives. And so on behalf of all 8,000 of the people that you have trained so far and many others from CFG Bank, residents and operators, patients in your communities, and then on behalf of the whole city of Baltimore, thank you for what you've done. And thank you for joining today. It's been a real pleasure, as it always is, talking with you.
It's really been fun. Yeah. Thank you so much for having me.
This podcast is provided for discussion and informational purposes only, for use by Declaration Partners, LP, together with its affiliates, referred to as Declaration. The information discussed in this podcast may change at any time without notice, and there is no duty by Declaration to update any person to whom this information is provided. This podcast does not constitute an offer to sell or the solicitation of an offer to purchase any investment product or any interest in the fund or any other investment vehicles or accounts managed or advised by Declaration, a Declaration investment product, in any jurisdiction to any person. Any such offer or solicitation for interest in any Declaration investment product will only be made pursuant to such Declaration investment product's definitive offering documents, which contain a description of the material terms, including risk factors, conflicts of interest, fees and charges, and regulatory and tax considerations relating to such Declaration investment product, and which should be reviewed carefully by potential investors prior to making an investment decision. This podcast does not constitute tax or legal advice. The listener is urged to consult a professional tax and/or legal advisors regarding the possible tax, legal, economic, regulatory, or other risks and consequences associated with any investment, and must be able to bear the risks involved. This podcast may contain certain forward-looking statements which constitute Declaration's views with respect to future events, which can be identified by the use of forward-looking terminology such as intend, seek, expect, target, project, or endeavor. These statements are made based upon such views as they exist as of the date herein. There is no assurance that such views are correct or will prove, with the passage of time, to be correct. Actual events or results may differ materially from those contemplated by such forward-looking statements as a result of factors beyond Declaration's control, including, without limitation, any disruptions in global, regional, or local financial, credit, or real estate markets, acts of God, fire, hurricanes, tropical storms, floods, earthquakes, or other natural disasters, outbreaks of an infectious disease, pandemic, or any other serious public health concern, war, terrorism, labor strikes, electricity shortages, or other national or local emergencies, or any combination of the foregoing. David M. Rubenstein is an anchor investor in Declaration Partners Real Estate Fund II and is not an employee of Declaration. Neither the U.S. Securities and Exchange Commission nor the Securities Regulatory Authority of any state or other jurisdiction has passed upon the accuracy or adequacy of this podcast. No compensation has been awarded to any speaker for statements made that are either testimonials or endorsements. However, certain speakers may be current or former investors in certain Declaration investment products and may receive reduced fees, priority terms, priority access, co-investment rates, among other preferential treatment, which may pose a conflict of interest. Certain speakers may also be affiliates and/or service providers that receive compensation from Declaration for services provided in their service provider capacity, but have not been compensated specifically for any testimonials or endorsements made herein. All statements made on the podcast are the opinions and beliefs of the speaker and may not necessarily represent the opinions, beliefs, and position of Declaration. Consequently, from the foregoing, no reliance whatsoever should be placed on this podcast, and no decision including any investment decision should be made based on this podcast or on the information contained herein.